A bloodbath on the street today, with Indian stock market witnessing mayhem as key indices recorded the biggest single-day fall since April this year. All stocks in the Sensex turning red, with Bajaj Finance, IndusInd Bank, Tata Steel, SBI, NTPC, M&M and Bajaj Finance being the biggest losers, down 4 to 6%. Heavy selling was seen across sectors, with nearly 9 lakh crore rupees of market cap being wiped out today. Fears of another massive COVID wave due to the Omicron variant, weakness in global markets, the beginning of a rate tightening cycle and year-end selling by foreign institutional investors are some of the key reasons for the biggest single-day fall since April in Indian stocks today. Sensex crashing 1,190 points, closing below 56,000. Nifty also down over 2%, barely holding on to 16,600. The indices had touched record highs just 2 months ago on the 19th of October. Since then, investors have lost nearly 25 lakh crore rupees from the peak market cap of 274.69 lakh crore rupees. While all sectoral indices were deep in the red, it was the Nifty Bank which hit a 5-month low after declining 3.3%. Heavy selling pressure was seen all across, with the Nifty Bank, auto, financial services, metal and realty falling 4 to 6% in trade today. FMCG, IT and pharma stocks didn't fall as sharply, retreating between 1.4 to 2.6%. Global markets also witnessed sharp cuts, with Japan's Nikkei and Hong Kong's Hang Seng falling over 2% each. China's Shanghai Composite was down 1%, while South Korea's Kospi had also fallen 1.8% during trade. Our global business editor Udayan Mukherjee joining us now. Udayan, what a day for the markets. Never react well to uncertainty, and we can question whether or not this was a fall waiting to happen or whether the markets are genuinely spooked. What's your reading on the fall that we saw today?
We've seen this coming, Abha, and I mean, if you recall, last few weeks we've been discussing this very possibility that a combination of factors were coming together to trigger this correction. The market has been resilient. It could have fallen earlier, but every time it went below that 17,000 mark, it found a way to come back. But I think the straws have added over the last few days on the camel's back, and therefore it's becoming more difficult to fight against the constant exodus or selling that we're seeing from global investors. I mean, that's topped $3 billion already for the month of December, and it's becoming very difficult to neutralize by the domestic institutional investors. I think the reasons are well known, and we've been discussing them. One, of course, is that there is a global panic on Omicron right now, and while in India the cases have not ballooned, the kind of lockdowns and restrictions that we're seeing in all other major economies is probably prompting some kind of a global panic. The other, of course, is, and perhaps the more important reason now, is that people are waking up to the fact that the era of easy money that we've got used to is slowly coming to an end. I mean, there might be a difference in timing on when you expect it to start, but the tapering has begun and interest rate hikes will follow in 2022. And now it's quite clear to everyone that easy money is probably a thing of the past. And whenever that happens, valuations get cut back, because the link between liquidity and valuations is absolutely undeniable. So what I think is happening now is the market is figuring that liquidity will be less going forward, and therefore valuation expansions won't happen, and earnings will have to do the heavy lifting. So I think the combination of Omicron and interest rate hikes or easy money going away is leading to a lot of selling from FIIs, and that's the reason the market is correcting. I think it should surprise no one, because it has been some time coming.
So what happens to all those investors that just got in, Udayan, given the recent spate of issues and listings, given the recent non-stop record highs that we've been seeing on stock markets, not just in the last few months, but dips apart in the last 2 years? They've just consistently been performing. So what happens now? What should an investor do now?
I think a little bit of a reset is in order. It's not helpful for investors to panic and say, something has changed, we should sell everything. That never helps anybody. But I think a little bit of a reset has to be there, because money making had become too easy, as you described yourself. I mean, the market had seen only up moves and no down moves or corrections or pullbacks at all over the last year or so, more than a year. And I think now the terrain will change. More volatility happens, maybe longer stretches of stocks not returning anything, I think those kind of phases will come about once again. This is not to say that we are entering a vicious bear market. Far from it. I think at this stage there is no evidence to suggest that. But I think after such a strong performance, investors should prepare themselves for maybe a year of not very good returns. But the problem is everybody keeps talking about a correction, Abha, but when it happens, people start panicking. I mean, nobody over the last few months has not spoken about the prospect of a correction. So it's happening right now. It should have been expected. And I think the right way to approach this is to say, don't rush into buying everything at the same time. Buy in a staggered way, because we don't know where the correction leads us. Sometimes corrections start somewhere and end somewhere else, as we have seen in the past. So buy in a staggered way and be prepared not to make money for 4 to 5 quarters. In the longer term, this may look like an opportunity, a long-awaited opportunity to buy those very good businesses that you've been waiting to buy. And don't try and get cute with that, the kind of stuff which fund managers talk about, that move money from one segment to another, buy companies which will protect your capital. Just buy the best businesses that you can find where valuations moderate. Don't care about what happens in 2022. Use this as a long-term opportunity, but there will be pain going forward.